All right, welcome back, Accounting 2 students. We are in Chapter 14, and we'll keep plugging through our different kind of adjustments. We've dealt with our trial balance and making sure that the debits and credit balance is equal before we move forward. We then did the simple adjustments that we have done in the past, making the asset supplies and prepaid insurance go down, the asset going down, and then recording the expense of those supplies or that insurance that helped you earn that revenue that year. Matching revenue with expenses accounting concept, essentially saying if it helped you earn revenue in the year 2019, you should have that expense be recorded in 2019. We talked about the allowance for uncollectibles, which was what happens when our account receivables, the sales on account that led to account receivables, what if we don't get all of that back? What if somebody has a tough time and their business shuts down and we don't get that money back? We get to an advanced level of accounting, we'll deal with writing them off and things like that, but we're going to guesstimate and say over the past several years, traditionally the amount of uncollectible is a certain percent of sales on account. We kind of make that adjustment for there. Next set of adjustments are going to be for something called depreciation. To understand depreciation, we're going to take one little step backwards and talk about the difference between current and planned assets. Now, your current assets will or could be used up or turned over in less than a year. Right? If I put $1 into my checkbook, that dollar in theory will be spent. Doesn't mean my checkbook goes to zero, but it means that dollar that went in February will eventually get spent probably before the end of the year. Supplies that go in will get used up, a lot of them that year. Not all of them. We look at our adjustments on the work together, and we had $4,000, $5,000, $6,000 worth of supplies for insurance, and we ended the year with a couple hundred. Right? Not all of it gets used up, but a lot of it gets used up. Okay? Plant assets are going to be around for a long time, right? They're not expected to turn over in a year. There's no official term. I guess long-term or plant assets mean more than 1 year. I like to say 5 years just to kind of put a frame of reference on it. And our plant assets are usually more expensive, right? You go buy a ream of paper or you go buy some pencils or pens compared to buying a new zero-turn lawnmower or a delivery truck or building a building, right? Those things are plant assets that is much more expensive. Your plant assets are going to help your company earn money during the year, and eventually those plant assets are going to be replaced, and they're going to be replaced at a high cost. So if we follow that matching revenue with expense idea, if we got a piece of equipment that's going to be useful for multiple years, and we're going to have to buy a new one and replace it, that's a really big price. Right? How are we going to show the using up of that piece of equipment? Do we buy it and use up all of the value in year one? Do we buy it and use up all the value when we replace it? Well, neither one of those makes sense, because let's say I buy a lawnmower and it's going to be useful to me for 4 years. I want to record a small portion of the using up over each of those 4 years, not all of it in year one, not all of it in year 4. So the idea we're talking about is depreciation, and it's going to be the calculating and spreading out of the using up of the plant asset over the useful life of whatever that piece of equipment is. This will give a more accurate record of the costs that go into earning the revenue in that particular fiscal period. So the idea we're talking about here is also book value. You take the value of your primary account and you subtract the contra account. We've already done this a little bit, right? We've done account receivables, and then we've subtracted the allowance for uncollectibles to get the book value of our account receivables. We will eventually take sales and net that out compared to sales discount and sales returns, right? Sales is the primary account, the discount and the return and allowance, that's the contra account, or opposite, it reduces a related account. Purchases is the primary account with purchase discount and purchase return and allowance being the contra account. We will come back to that in a little bit because we're going to do the book value of a particular asset. So how do we do it? In Accounting 2, we're going to deal with just one type of depreciation called straight line. There are 3 or 4 other different methods of calculating the using up of a piece of equipment. We're just going to deal with the simplest one that has equal spread of using it up over each year. So we start with the original price of the plant asset. We're going to subtract what we can salvage or what we think we can scrap it for, trade in maybe, another way of looking at it. Then we're going to divide that math by the number of useful years for that piece of equipment. These are our best guesses, right? Salvage, we can't guarantee what the scrap value is going to be. We may wear it out to the point where they give us nothing, but traditionally we're going to think, hey, this X number of year old piece of equipment could get traded in for such and such. We understand that things last longer than they're supposed to. Sometimes things don't last as long as they're supposed to. But we can make educated guesses to say that this piece of equipment should last this long. That'll calculate our annual depreciation for a full year. Again, more advanced than I need you to worry about. What if we buy it in the middle of a year? Well, then we'd have to calculate partial year or take a full year and divide it by 12 to get to the full month's worth of use and then build it from there. So here's our sample. Clem's going to buy a new zero-turn lawnmower. Sticker price is $14,000. I think I can trade it in 4 years for $2,000. So original price minus the salvage value. So 14 minus 2. I'm going to use up $12,000 worth of value of this piece of equipment in 4 years. So I'm going to use up $3,000 worth per year. So if we're going to use up $3,000 per year, here is our adjusting entry. The expense account gets the debit, and it's going to be depreciation expense, equipment or store equipment or office equipment or land or building or whatever it happens to be. And then the credit is going to go to accumulated depreciation, store equipment, office equipment, land, building, whatever. Now we get to book value, right? On the books, we have a piece of equipment that has a sticker price of $14,000. We can't go backwards and change that and say, well, we paid 14, but it's really worth to us only 11. So we need this contra account, this accumulated depreciation account, to reduce a related account. Book value of our equipment is really $11,000 at the end of year one. Right? The $14,000 lawnmower after a year's worth of use is not worth $14,000. We're saying it's worth 11. So here's the books example. Subtract the assets salvage from cost. It's got a $1,250 piece of equipment. They think they can scrap it for $250. They're going to use up a total of $1,000 over the whole life of the product. This product they think is this piece of equipment is going to be useful for 5 years, so they're going to show the using up of $200 per year for the next 5 years. And we'll get to this later. So there's a calculation of book value. So we look at it from a trial balance point of view. Again, here's our trial balance. We had office equipment. Maybe it's more than one piece of equipment, but we have office equipment that had sticker prices of $35,864.50. We used up $6,400 so far. Looks like we're using up another $6,500. We could look at this and say, well, this is 2-year-old equipment, right? We bought it 2 years ago. We used up $6,500 last year. We're using up another $6,500 this year. Book value of that piece of equipment is $35,864.50. Minus the $6,400 used up last year, minus the $6,540 we used up this year. Book value of that piece of equipment should be $22,827.50. Balance sheet's still going to show the $35,000, and now accumulated depreciation will show $12,000, probably $13,000 when you add these two together. Here's store equipment, and again, we could have 5, 6, 7 different kind of plant assets. We just got 2. Sticker prices were $40,000. We used up $5,000 in the past. We're using another $5,000. Again, can kind of clue us in and say, hey, these are 2-year-old pieces of equipment. Debit to the expenses, credit to the accumulated depreciation. So accumulated depreciation is a contra account opposite of office equipment. So we plug in our debit amounts to the expenses, plug in the credit amounts to the accumulated depreciation, and labor law adjustments. So our ideas we covered here were current assets versus plant assets, depreciation expense, estimated salvage value, straight line depreciation, accumulated depreciation, and book value of a plant asset.